Welcome back to Am I Catching a Falling Knife? The podcast where we dive deep into stocks taking a tumble, trying to figure out if there's an opportunity lurking in the volatility. I'm your host, Dave, and today we're shining our spotlight on Enphase Energy, ticker symbol ENPH. Now, ENPH has had a rough go lately, shedding about 15% of its value over the last few days. That's a significant drop, and it certainly puts it squarely in potential falling knife territory. So let's peel back the layers and see what's really going on here. All right, so what's the story here with ENPH? Well, the immediate buzz, the single most dominant market narrative, is all about the anticipated downturn in the U.S. residential solar market. And why is that? It boils down to federal tax credits for homeowners drying up. This change has led Enphase to reduce their revenue guidance, and naturally, analysts have followed suit with downgrades. It's a classic case of market sentiment shifting based on regulatory and demand changes. So, who exactly is Enphase Energy Inc.? They're an American energy tech company based in California. They're primarily known for pioneering and commercializing solar microinverters, which are crucial for making solar power installations more efficient and resilient, especially for residential customers globally. But beyond just microinverters, they've expanded into battery energy storage systems and even EV charging stations, all integrated onto a single platform. When we look at their revenue, it's 100% from solar PV and energy solutions, and a significant chunk, about 70.26%, comes right from the United States. That's a crucial number, as you'll soon see. Now let's get into the numbers. How does this narrative of a U.S. residential solar market downturn actually impact Enphase's potential earnings? Let's break down the calculation step by step. First, as I just mentioned, Enphase generates over 70% of its revenue from the United States. So, if the U.S. residential market is facing a downturn, that's their primary segment taking a direct hit. Next, considering that these federal tax credits are ending and Enphase has already lowered its revenue guidance, we've estimated a significant decline, around 18%, specifically within their U.S. residential segment for the upcoming quarter. Think of it as a pretty chunky piece of their pie shrinking. Now, how does that translate to the entire company? Well, if 70.26% of their revenue is from the U.S. and that segment is projected to decline by 18%, then the overall company revenue impact is calculated by multiplying those two percentages, 70.26% times 18%, which gives us a projected negative 12.65% decrease in total quarterly revenue. That's a noticeable top-line hit, but it gets even more interesting when we look at profitability. Enphase has a healthy trailing 12-month gross margin of almost 48%. Assuming their operating expenses don't magically shrink at the same rate as revenue in the short term, which is typical due to operating leverage, a 12.65% revenue drop can have a much larger percentage impact on earnings. If we estimate their operating margin at roughly 20%, that revenue impact gets magnified. When you do the math, that 12.65% revenue hit can lead to an estimated impact on quarterly earnings of about negative 30.30%. To put a little wiggle room on that, we're looking at a confidence interval of negative 35% to negative 25%. Why the range? Because precisely quantifying the downturn and how fast Enphase can adjust to its operations to it still has some inherent uncertainties. The direction is clear, but the exact magnitude is a bit fluid. So, what does this mean for a fair value? To get a baseline, I ran a discounted cash flow model. For this, I used a 5-year growth rate of 3.59%, which is based on analyst expectations. My discount rate, or the hurdle rate for this investment, was set at 9.5%, and for the long term, a terminal growth rate of 2.5%. Based on those assumptions, the model's base case gave us a fair value of approximately $19.48. But remember, that's without the narrative's full punch. When we apply the significant earnings hit we just walked through, the narrative adjusted fair value drops considerably, coming in at about $12.66. This tells you just how much the market's current narrative about the U.S. solar market is impacting the perceived value. Given these calculations, when we look at potential buy levels for ENPH, thinking about where the stock might find support if this narrative plays out, my custom levels are currently set at $19, $12, and $10. You can see how that $12 level aligns pretty closely with our narrative-adjusted fair value. These are points where, based on the numbers, the risk-reward might start to look more compelling if you're willing to catch this particular falling knife. All right, that wraps up our deep dive into Enphase Energy. Always do your own thorough research, consult with a qualified financial advisor, and understand your own risk tolerance before making any investment decisions. Thanks for tuning in to Am I Catching a Falling Knife? I'm Dave, and I'll catch you next time. Stay safe out there.